Waste Management, a company that disposes of your trash, has been falling over the past month and has fallen quite a bit from their all-time high of $230 and is trading closer to its 52-week low. If we direct the attention to their PE ratio over the past year, we can see that they have been trading quite expensive, so this fall in price might be opening up an opportunity to buy the company at a discounted price. Now, if we have a look at the 10-year chart, we can see that from about 2016 to about 2018, the company was trading quite fairly valued compared to their PE ratio, but since then the PE ratio started rising quite rapidly with the company's price. And now more than ever, with the market being so overvalued, do you not want to buy into an overvalued position? So moving to the 9-pillar analysis, we can see that Waste Management gets a rating of 5 out of 9 with quite a bit of red on the screen. Now let's direct our attention to the PE ratio, which over the past 5 years was sitting at about 29. Now if we have a closer look, we can see that currently it is sitting at 31, which is higher than the 5-year average. But Waste Management has successfully been pushing their PE ratio down over the past 5 years at a rate of about 0.5%. But year over year, we can see that the P ratio did rise by quite a lot, making the company overvalued for my taste. But let's see if they're actually trading overpriced compared to their competitors. So moving to the multiples valuation, we will compare Waste Management to 4 of its peers. We will take these peers' current stock prices and divide by their earnings per share and get their PE ratios, which we will average out to get an average PE of 40.11. Now if we multiply this average PE with the earnings per share of Waste Management, we get an intrinsic value of $262.29, which shows us that compared to its sector, Waste Management's PE ratio isn't actually looking all that bad. But let's also have a look at the price to free cash flow, as free cash flow is much more reliable as it cannot be manipulated by management. And we can see that this ratio is actually sitting at 45.85, which is almost twice as much than the 5-year average, and has actually been increasing at an average rate of 26.87%. But how come? How come the price to free cash flow is increasing while the PE ratio is decreasing? Well, that is quite simple. If we move to pillar number 4, we can see that the net income has been rising quite steadily over the past 5 years at a rate of about 9.29%, and year over year it grows by another 14.63%. But if we jump to pillar number 5, we can see that the free cash flow has actually been declining quite a bit at a rate of about 0.69% and is currently sitting lower than what it was in 2019. Now, Waste Management has actually been decreasing the shares outstanding at a rate of about 1.15% every single year over the past 5 years, but that still isn't enough with the decreasing free cash flow and the rapidly increasing price of the company to push down the price to free cash flow. So now that we're at the free cash flow, let's actually calculate the intrinsic value of the company compared to their free cash flow. So looking into the discounted cash flow model, we plug in the free cash flow over the past 5 years and calculate a negative average growth rate. Now into the future, I predict a high growth of 5%, medium growth of 4%, and a low growth of 2%, and get a calculated growth rate of 3.7% into the next 10 years plus. I then use this growth rate to calculate the future free cash flow, including the terminal value. Now to move forward, we have to plug in a discount rate, which is essentially the minimum rate of return we want from our investment. And I plugged in a discount rate at 6.4%, and using that I calculate the present value of that future free cash flow. Now after doing the mathematics, we get an intrinsic value of only $96.18, showing us that indeed Waste Management is extremely overvalued compared to the little free cash flow they generate. Now I want to show you another thing that I'm a little concerned about regarding Waste Management, and that is the long-term liabilities over the 5-year free cash flow and negative dividends, which is sitting at 5.70 while we want it to be sitting below 3. This pillar essentially tells us whether a company generates enough free cash flow to cover all their long-term liabilities while paying out their current dividend. Now if we have a closer look, we can see that Waste Management has actually been increasing their long-term liabilities over the past 5 years at a rate of 4.75%, which I very much don't like, for one of two reasons. One, obviously, that they have more long-term liabilities to pay down in the future, and the second one being that by taking on debt, they essentially generate free cash flow. And so the little free cash flow they generated over the past few years was mostly the debt they took on. So Waste Management really isn't doing too well regarding their free cash flow. But let's try to direct our attention to something more positive, and that is their earnings per share. We can see that over the past 5 years, their earnings per share have been growing very nicely, even though they have been skyrocketing in stock price. So let's calculate their intrinsic value compared to their earnings per share using the Graham's formula. Now here we obviously have to plug in the high earnings per share growth, the medium earnings per share growth, and the low earnings per share growth. So let's jump to Seeking Alpha and have a look at the earnings estimates over the next 4 years. So we can see a growth of 10% in 2025, about 10% in 2026, 15% in 27, and a low growth of 5% in 28. Now, based on this and the research I did in the backend, I will plug in my high earnings per share growth estimate at 15% over the next 5 years, my medium earnings per share growth estimate at 10%, and as I want to be conservative, the low earnings per share estimate at 6%. And after averaging this out with the 5-year earnings growth estimate of the analysts, we get a yearly growth of 10.30%. Now, taking all these values and plugging them into the Graham's formula, we get an intrinsic value of only $109.44, which is 88% lower than the current trading price of the company, which shows us that even with their very nice growth in the earnings per share, they would still be considered overvalued compared to the earnings per share they currently generate. Now, as Waste Management is a dividend company, let's also have a look at their dividends. We can see that they have a 5-year free cash flow payout ratio of 52.57%, which is quite fine with me as they don't need to direct a lot of it into innovation. So the 50% they have left over after paying out their dividends is enough to increase the dividend into the future, pay down debt, and buy back shares. Now, their 5-year dividend growth is above average at 7.59% yearly. The average is about 4.13%, but they do have a below average dividend yield of 1.46%, which I don't really mind as the high dividend growth is what I am after, as that is the one thing that really kicks in the dividend snowball effect. So now let's also calculate Waste Management's intrinsic value compared to their dividends. So jumping to the dividend discount model, we plug in the dividend payouts over the past 5 years and calculate an average growth rate of 8.15%. Now, as I do want to be a little more conservative, I plug in a high growth of 10%, medium of 8, and low of 5, and that gives me a projected growth rate of 7.67% into the future. Now, plugging in a discount rate at 6.4%, which we already plugged in our discounted cash flow model, we will actually get a negative intrinsic value, and that is because when the discount rate is lower than the projected growth rate, the mathematics within the model don't work. So we have our alternative model where we plug in the next year's dividend calculated through our projected growth rate, the stock price next year predicted by analysts, and the discount rate, and get an intrinsic value of $220.02, which is higher than the current trading price, showing us that Waste Management really does have some good dividend growth. And now that we have gone through all 4 valuation models, let's go to the ultimate value and average them out. And this will give us an ultimate intrinsic value of $171.98, which is 16% lower than the current trading price of the company. And with a margin of safety of 10%, we would get an acceptable buy price at $154.78. So overall, Waste Management would be considered undervalued compared to their peers, but overvalued by a lot compared to the whole market. And that doesn't surprise me at all because, as we know, the whole market is currently very overvalued. Their free cash flow also isn't doing too well, but they do have very decent dividend growth, but that could be in danger if they don't start raising their free cash flow within the next few years. And with that, I hope that you enjoyed the video. Make sure to leave a like and subscribe as it really helps me out.